Good morning, guys. Today is April 17th, Wednesday. Hope everybody is well. I'm not going to comment specifically on the market. I think it's going to continue to consolidate a little bit, maybe move down a little bit more. Uh, Again, the market has gone up 36% since October of 2023, NASDAQ especially. And then this is the 4.5% to 5% pullback. Very much normal, expected, and probably good for the market overall. One of the companies that's going to report next week is Netflix. Now, Netflix, most people know already, actually this week. So most people know already. So it's not like as if you are as a user not aware of what Netflix does or what Netflix is or what are the key things that Netflix provides. What I wanted to do was talk about the key challenges and the good things that are going for Netflix in the next couple of years and see what the opportunity provides for us to see if this might be a good place to buy and what might be the good place to buy Netflix. So let me summarize the key important points of this first. First, Netflix is a streaming provider. They are the largest and the most profitable of all the streaming providers online. They have scale. They have a 260 million subscribers worldwide. They have 140 viewers in the US alone, little over 60 million subscribers in the US and 140 million viewers, which is some people buy it and have the whole family use it, for example. They have streaming shows. Now they've branched into streaming gaming, which includes Grand Theft Auto and other games. And they're also doing live sports is one of the key parts that they're trying to move into as well. The other big change, so that's the first thing, they're moving outside of their core, building great franchises or buying rights to great content and streaming it. The second thing that they're doing is moving to more of an ad tier supported by advertisements as opposed to subscriptions alone. Netflix for the longest time used to be a pure subscription business. Remember, their history was they started by sending DVDs, then they moved to streaming. Their streaming was completely paid for on an annualized basis. Then they moved to advertising tier in the last 1 year, 2023 early. Microsoft was a partner for them to be able to stream content. Netflix on an average gets anywhere between $45 to $50 per CPM, which is number of eyeballs on that system for a 15-second ad, 30-second ad, if you will, that gets placed on Netflix. So it's fairly high level content. Give you context, YouTube, on the other hand, is closer to the $20, $30 range, so almost half the size. But Netflix advertising is going to be already a $7 billion business in the next 3 to 5 years, growing very strong, growing very well. So they'll probably be in the top 5 in terms of advertising, after number 1 being Meta, number 2 being Google, or number 1 and number 2, depending on how we look at it, Meta and Google, and then Amazon and Netflix are probably going to get to the top 5 in terms of advertising-driven revenues. That's a second big change, moving to advertising. And third big change is moving global and international, acquiring more content internationally. So those are the big 3 changes. And the question now is, can Netflix double from where it is right now and continue its growth? Those are the things that we're going to explore. So Netflix makes money by getting you to subscribe and by getting advertisers to put advertisements on them. To do that, they create content or they buy content, acquisition of content, or make and produce shows. So how do they do this? They essentially go to all the studios, whether it's Warner Brothers and Columbia, Sony Pictures, and a whole bunch of smaller studios as well. And they might go ahead and tell them, make this show for us because of the data that we have. We think people of our audience would like this kind of a show. They do that. Or on the flip side, the studios themselves come and say, we have this idea, we have that idea, we'd like to be able to have it funded by Netflix. That costs essentially about $70 to $20 billion annually for Netflix. Either they go and assign someone and say, build this kind of a content for me, movie, TV show, etc., or they might get pitched by somebody who wants to create content. The other side of it is you go to NBC, you go to ABC, you go to CBS, you go to Fox, you go to all of these other studios and producers of content, and we'd like to be able to license your content to play on our system. Now, roughly about 55% of that content is acquired from third parties, things like Seinfeld or things like Friends, and 45% of the content is actually produced by Netflix. They used to have a lot more emphasis on this produced content side, and now they're moving more towards acquired content. Not one bad or the other, but it's just that's the way they're trying to move given the new people that are running. Netflix has a ton of popular shows. Most people probably know about some kind of a show that Netflix has that they watched or they're watching or they're interested in. I don't know 90%, if not, I can't even remember, except for 1 or 2 shows. I don't even remember all these shows. I don't watch Netflix a lot. Even I watch very specific things, and that too for not a lot of time. Most of my content that is consumed is a combination of YouTube and just listening to a lot of people. I don't go to a lot of movies as well. Most of my content is with podcasts, so I spend a lot more time with podcasts and with YouTube than necessarily Netflix, if you will. But if you look at these popular shows, non-English shows, the view hours are a lot more given how big outside of the US Netflix also is, especially in places such as Korea and India. Outside of that as well. So outside of the US, non-English shows, a lot bigger in terms of the growth. The other big change that is happening to Netflix is the growth of Netflix games. Now, once you have a streaming service, I talked about it yesterday. I don't know if you got a chance to see it, but I'll try and put an image at the end of this presentation. There are four major US-based subscription companies that pay you to give you money for content or subscription of some sort. Amazon is number one with their Prime at 160 million, 180 million users. Actually, yesterday they announced 180 million users. Now, not all of them are paid. A lot of them are just people who might have, for example, I have two kids in my Amazon Prime subscription, 180 million. Number two is Costco with 120 million members, 66 million paid. Number three is Netflix with 66 million in the US, 140 million viewers, 66 million paid subscribers. And number four is Spotify with about 43 million paid subscribers. Now, once you have a $66 million subscriber paying customer base, you can then push a lot of different things to them. Netflix games is additional above and beyond what they already saw in terms of. So the idea is to keep you on Netflix for as much time as possible. Talk a little bit about what the viewership eyeballs go to. And Netflix is trying to keep your eyeball on Netflix a lot of different times. To that extent, they're building games, they're buying game studios. They're also partnered with a lot of game studios to bring gaming to the Netflix apps. It is usually in the kind of demographic that Netflix has. They're not buying console games. They're using things like Grand Theft Auto, but a lot of it is just mobile gaming, casual gaming, as opposed to console-based intense gaming. So they're trying to be bigger in the gaming area. That's an opportunity for them because they look at themselves as an entertainment company. They want to be able to get as much of your eyeballs as possible. When they do that, they spend more time, which means they can spend more advertising dollars and get some subscription revenue as well. The other big area that they're putting a focus on is live shows. Now, streaming has grown dramatically. You heard of a lot of things about cord cutters, not cost cutters. Cord cutters, essentially people that are getting rid of their cable subscription and going to streaming alone with a combination of Disney or Apple Plus or Netflix, Amazon Prime, etc. Now, while that happens, the only thing that is still being viewed live on television, linear television as we call it, is essentially sports, primarily NFL, NBA, MLB, lots of different sports. In India, it's cricket. In the Europe region, it is soccer. So Netflix is now trying to work with deals very similar to what Amazon Prime has done. Amazon Prime has also gotten deals with NFL for Monday Night Football last year, 2023. Amazon had Thursday Night Football exclusively streaming on Amazon, so you couldn't get it anywhere else. So think about those things as the important content capabilities that Netflix is bringing about. Live gaming, they also have golf. I think it is a big part of what they're trying to do. So gaming and live sports, the big expansion areas for them. Where are they growing? They're growing a lot more internationally, international viewer base. So this is 667 million was about a year, 2 years ago. Now they're at 206 million, growing faster than that ever. Amazing amount of growth for Netflix after a couple of years of just struggling. Now they're back on the growth. So this has now gone to 250, 260 million. Paid subscribers is growing very, very well for Netflix, and they're continuing to do that. So this in the US has gone to viewers about 140 million, and the overall subscribers has gone to 260. In overall growth, the key thing that drives a lot of people, and especially the analysts, is what is the subscriber growth growing as on an ongoing basis. From 2019 to 2023, subscriber growth on a quarterly basis has grown. It has been up and down to a large extent, but this actually shows you it went down quite a bit. And then 2023 actually is showing a much better movement. They actually lost a lot of subscribers in 2022. Stock dropped all the way to about $300. And now it's right back up. So they're growing very well. This was because of two important changes that they made. Password crackdown. That started somewhere in this time frame and has continued on an ongoing basis, not allowing people to share their passwords with others by doing geofencing and a whole host of other capabilities that they would use. So a lot more people subscribing. That's a big change that they made. Second, they introduced an ad tier, making it a little expensive for people to be able to join in as well. That has also allowed them to be able to get a lot of benefit from this. Initially, a lot of analysts suspected that they're going to get a lot of backlash from the password sharing crackdown. That didn't happen. Netflix has actually grown significantly. And if you look at this, they're getting back to literally what they did. This was pandemic. This was pandemic growth. 2020 pandemic, everybody just suddenly went and said, we're going to buy Netflix subscriptions because sitting at home. And that moved it up pretty significantly by 15 million for that quarter. Since then, it was a drop. Now it's going steadily back up again to 13 million from 15 million. That was pretty good. Now, Netflix viewers overall, 2023, if you look at the US alone, 140 million is what some people say, 170 million is total number of viewers, according to Netflix itself. Percentage of the population, nearly 50% of the US population is watching Netflix. I think it's probably a little bit more, not able to count some of these because it's by login, but Netflix has about 170 just within the last few years. They've gone from 150 US viewers to 170 viewers million in the US. Very strong growth, consistent. 50% of the people in the US watch Netflix. To give you context, 89% of people watch YouTube. Okay, so YouTube is still the number one streaming service by far, by a wide margin. But the number two being Netflix is a lot more paid. The number of subscribing users, to give you context on YouTube side, is about 60 million. So YouTube has a far fewer number, smaller base of subscribing users, including YouTube TV and YouTube Live and YouTube Gaming. YouTube is also competing. And Amazon claims to 180, 100, claims to have 180 million users of Amazon Prime, and not all of them are paid. But the number of viewers at Amazon Prime is not disclosed. So it's probably much lower than 180 million for sure. Netflix is by far the most frequent. So when you look at it overall outside of the United States as well, Netflix is still fairly dominant overall. Other streaming in places like Poland and so on, very localized content. But within the US, most of this is still cable, but Netflix is by far the largest, as you can see here. And then YouTube, obviously, everybody uses YouTube. I meant to say that. I'm sorry. So Netflix growth, if you look at it outside of the US, Netflix and YouTube, very, very good. Other streaming services in the UK tend to do well. So it's more BBC, I would imagine, more than anything else. So YouTube, very confident, very big, doing very well. Amazon Prime and Hulu, they're a distant number two, number three, I think. And then Apple TV should show up somewhere over here, but it'll probably show up only within the US. Outside of the US, Apple TV is not very popular, guys. So it's growing very well, growing very quickly, and linear and other typically tends to be the only bigger portion that they're going to eat into. This is where I think eventually it's going to get to. This is where it is eventually going to get to for everybody. Even the US would probably get somewhere over here. Whether Amazon and others gain or other solutions gain, there are a whole host of them, right? So you guys have probably heard of Discovery TV in the US. There are people that are buying subscription to Paramount Plus, HBO Plus. I mean, the dime a dozen of these, but Netflix will continue to grow. So pricing. One of the big things that is interesting is Netflix offers different pricing in different locations and geofences them. So when you go out of that location, you're going to find content that is only available in one location that's probably not available in other locations. Fairly consistent in terms of pricing within a range. Right, so you'll find that it's between $5 at the low end in some places, all the way to about $8 for the basic with ads tier. It's a fairly consistent price wherever you buy it in the United States or in other countries, or especially in the OECD. But if you go to India, it's a lot cheaper. That doesn't mean you're going to get content that is available in the US. You're just going to get India-specific content because of content rights that they have to work with. Overall, Netflix has multiple tiers. They've increased the prices on all of these. It's going from $7.99 basic without ads and $9.99, and then all the way now, this has become $24.99 from $19.99. So very, very large, very, very consistent. Pricing is improving. Pricing is getting better, more expensive. By 2027, they're expecting to generate more than $7 billion in ads, which will make them a number 5 player in the advertising space, digital advertising space, growing very, very quickly. Microsoft is the partner for them for digital ads. So Microsoft not only works with the advertisers to source the ads, to create the ads, and then make sure that the display system happens within Netflix. So overall share of advertising revenue, Netflix will be at about a 21% growth rate. That's very, very strong. Their overall advertising revenue is growing 66% if you look at this overall. That's very, very good. And they'll get to about 21% of all streaming advertising, not overall digital advertising. If they get to 7 billion, they'll still be probably in the five or so within streaming. Now, Netflix users, more and more people, remember, this wasn't even there in 2021, 2022. This is just dramatically increasing. The basic with ads has been a phenomenal tier. What does it come at the expense of? The top tier, the premium tier that they have is the one that is getting a lot more people, or they've actually just slowed down. It's just this user base that is coming in is new. That's why the percentages have gone down. So this is 100% total, but if you look at it overall, the pie has actually increased from here to here a lot more, 160 million, as I showed you, to about 260 million. So this is getting a lot more people coming in new as the other tiers. And once they come in new, some people tend to migrate from here, but a lot of people are going from here to here and from here to the ad-based network. If Netflix were less expensive tier ads, more than 50% of people said that they will actually go with the pre-roll ads for $5 or less per month. And if they do it for mid-roll and pre-roll, 60% of them would go. That's amazing. That means more people are okay accepting ads. Now, this is the same set of people, maybe not the same set of people, the different people. A lot of people complain about ads online. I don't get it. When you tell them the price of Netflix is going to go to $5 a month from $6.99 that it is right now, but you have to see ads both pre-roll, which is the beginning of the movie or the show, and mid-roll, more people want to actually see the ads. That's ridiculous. Okay, less expensive tier. This is the thing that is interesting. You look at the differences between this June 20. Actually, these are both the same thing. Apologize. Now, Netflix. Where are people switching from? The basic with ads is coming from a lot of people who were previously not signed up. So a lot of things like my kids, she moved to a new location completely on her own right now, starts earning money, and essentially she gave up the subscription. She tends to buy it only for a month, watch a lot of stuff, then give up and go to Hulu. That's what they tend to do. A lot of kids tend to do that. But a lot of the basic tier ad switches are coming from people that were previously in the basic plan. 67% were in the basic plan. Now they're going to the basic tier with ads. And a lot of them are resubscriptions, if you will. First time was smaller, but people that previously used to use Netflix got rid of Netflix, then came back and said, I want to try the free tier because it's less expensive, started getting more expensive at $7.99, $8.99, etc. So that's where a lot of the new free tier Netflix coming from. Within the US, a lot more of the companies and the customers, this is 2022 data, but the demand is still much, much larger than all the other US-based competitors. Look at this overall. You look at Netflix overall, it is still way above everybody else. They are only increasing share, not getting, this is actually this way. This is the way to look at it. It's a little bit lower, but the other company that's increasing share is a lot of the other third-party providers, Discovery, Paramount, a lot of those guys as well. Amazon has been consistently at 10%. Apple TV has been consistently non-existent, less than 5%. So it's been good, but I think to a large extent, a lot of other players such as Discovery are also starting to gain a little bit of share overall. Now, the preliminary forecast, as I mentioned to you, a lot of it is going to come from the growth that is expected, and the ad tier is expected to add to a lot more of Netflix. The streaming ad tier, Netflix is still expected to be the number one by the end of 2024 by far. They're going to make about 2 billion or so in the ad tier just with advertising. Now, besides that, they're also going to the ad tier outside of the US, especially in APAC and Latin America, where the quality or the amount of money that they can afford is a lot less. And the estimates are that they're going to make a lot more money in EMEA from advertising-based systems, even though all of Europe seems to hate advertising. Okay, if you look at the competitors, and especially in the streaming side, that with ads is overall just growing across the board for a lot of these companies. Everybody is growing the basic plan. This includes Hulu, by the way. Disney went and purchased out Hulu. Hulu comes in multiple different options. Besides Disney Plus, Hulu has a lot of the content even from competitors, not just from ABC and Disney, which is Disney owns ABC, but a lot more people willing to happy with advertising based networks, which is a big value add. Now, the reason why Netflix wants to do this is because they make more money. It's simple. If you had a same user spending 20 hours watching Netflix or 50 hours watching Netflix, whatever the answer is on a monthly basis, the amount of money Netflix makes with them from a subscription basis alone is about $6.99, $7.99 if they were only subscription. With ad, they probably get closer on an ARPU basis to about $8.24. So the average revenue per user increases with ads. That's why all of these providers, including Disney Plus, announced that they're going to more of an ad revenue. But 2023 is about double now. It used to be 5 billion. They're going to get to about 7 billion is the projected revenue. Netflix ad budget, how much they spend on originals versus acquisition. It used to be more acquisition oriented, which means that they would commission shows or they would go to studios and say, we'd like to pay for this show. Now it's getting to a lot more of the originals that they are trying to be able to go ahead and do. So they're increasing it a little bit more. They would buy out the show. Now originals are essentially, so they're spending a little bit more time with the intent, but I'm seeing the data even from last week. The emphasis from Netflix seems to be, I'm going to do a little bit less or the original ones, not going to do a lot more acquisition. So this is still a debate. They keep going back and forth. Original means it's only to Netflix unique show. You can't get it anywhere else, which drives people to come in. But the acquisitions are the ones that keeps people watching the show. Those are the two things, acquisition and retention. Acquisition, if you don't get it anywhere else, you're going to come in and join Netflix. Retention, if you find something that is worth watching again and again, you're going to be there. So you have to do a combination of both. Programming spend wise, Netflix is still going to be, this is on a quarterly basis, Netflix is going to be about the $20 billion range. Look at this. Their projection for 2024 for 10% growth. This year now, they're about $20 billion. Streaming costs themselves, just for the content, Amazon played quite a bit. And Netflix was 13, but now they've gone to about 17 billion to 19 billion dollars, growing much faster than Amazon Prime. Amazon Prime also played a lot more because of real games such as NFL and so on and so forth. So in terms of overall streaming ratings wise, YouTube is still number one overall. Within the streaming area, YouTube is still number one, as I mentioned before. A whole lot of other streaming that you will get from Vivid and other places, but still, YouTube is number one. This is within streaming. So the money that streaming is going to go, the pie increases when moved from here to here. A lot more people from cable. This will probably get to the 25% range in the next 5 years. And as this becomes a lot more smaller, more people are moving here to streaming. So the video on demand, VOD, primarily the big advantage within the various different networks, whether it's Apple, Netflix, Amazon Prime, etc., what they're spending money on is more on crime and thriller related genres. The second genre is science fiction and fantasy. These two make up over 50% of most of these people. Crime, thriller, and science fiction. All the rest of them make less than about 40%. Just look at that. Except for the case of Amazon Video, where they seem to be managing it a little bit better. They have a long tail. All of these are just primarily just crime seems to be the big thing. And of course, science fi drama, because of Star Trek and things of that nature, Disney Plus tends to do fairly well in that one. Content cash spend overall from the $19 billion to $20 billion range will be about 14-15% of the total streaming spend for Netflix. So this is the overall industry spend on content, whether it's acquisition or it's original shows. Netflix is about, as I said, 17 to $19 billion, of which 136 billion is roughly about 15% or so. A lot more content international. That's the growth for Netflix overall. Now, they've gone to about 19 in terms of projection. The content spend is consistently increasing. In 2023, now they're about a $20 billion movement. That's fairly large. They're spending $19 to $20 billion on content and bringing in revenue also to be able to support that. So that's good. But they have very good pricing power. Unlike on Spotify, which has a 25% gross margin, Netflix is actually good, about 30-40% gross margins. That's pretty good. So they're spending a lot more money on original content, which is exclusive to Netflix shows. And the reason for that is because they're earning a lot more customers and they're winning a lot more awards for the original content. So that's Netflix, just the key most important things. To summarize again, the big changes for Netflix primarily are number one, ad-based tier. Number two, getting a lot more users to grow back again because of password crackdown. Number three, the move to streaming and gaming. Streaming gaming shows and live TV. And the other big change for them is going more international. Those are the big things that Netflix seems to be most happy about that I think they will continue to do very, very well with. So if you look at that as the big changes, now let's look at our 5-step analysis, see what we get. Okay, we go to the fundamentals, we go to the financials. Now, Netflix overall, revenue-wise, growth stalled a little bit and slowed down a little bit in the middle during the days after COVID, especially when during COVID, 2020 March first quarter, they just absolutely ramped up, went very, very quick, went very, very fast, did a very big growth. And then after that, they've been slowing down since then. To a large extent, that slow growth was primarily because of them finding a lot more people not willing to spend that much money because they didn't watch it as frequently and so on. But now they're getting back to that point again. So 8 years, 11 billion to 33 billion, three times, 3x growth, phenomenal. So 35% 2018. This was very strong, but not as strong as 2018. I would say that was good. But $11 billion, $33 billion. They're spending about $14 billion. The $14 billion, so $19 billion in content spend, plus all the other additionals in terms of the streaming, data, tiering, technology, etc. So $14 billion, about 40-50% margins gross, net margins in the 15% range. EPS diluted about $12 a share. So look at this. EPS growth actually was very good. So they did a much better job of being tight-fisted, and cost cutting was done very, very well. $12 a share from what, $10 the previous year, if you will. On a quarterly basis, this is the big story. 2% growth, single-digit growth for Netflix in 2022 has now become double-digit growth in Q4 of 2023, which is going to continue to grow. Still good margins at about the 40% range. Net margins still in the 10-15% range. Very strong. Very strong growth now. Double-digit growth is nothing to sneeze at, especially when you're doing $33 billion. They have about $9 billion in cash. What do they have the other assets on? Deferred charges. I've got to explore that, but I don't think that's a very good sign, but it's okay. Now we look at the total cash that I said is $9 billion, $10 billion. Total debt is about 16 billion. So they have quite a bit of debt. The net to equity ratio is quite a bit, about 10 billion in negative. So that's a little bit of a challenge, but they have a ton of cash flow to back it up. So I don't think that's a big worry for them. $1.5 billion in cash. They do buy back their shares very frequently, given the fact they do a ton of stock-based compensation. But relative to some of the smaller companies, they're very reasonable. Price to earnings of 51 for 12% growth is a little bit high. For a 40% margin stock, 40%, 39, 40%, I would say, 10 to 15% net margin. This also is very high, but they're banking on the growth. Solid company, great growth. Will it double from here? It's about 265 billion. To get to $500 billion, they have to get about $60 billion. You're going to get 7 billion of that just over the next 5 years on ad growth. So where are they going to get the new users from is the question. Can they convert more people who are on their parents' network or on sharing their parents' account to then go ahead and buy their own? 260 million, they have to get to about 500 million. Can they get to 500 million paid subscribers? I don't know about that, but they have to be able to, at least, even if they don't double the revenue, the multiples are very large right now. You look at it, the multiple in terms of the price to sales and price to earnings is fairly high. So that's going to be the challenge. Let's look at the forecast out over the next couple of years at least. Okay, EPS goes from $12 to 70. So this is a big EPS jump. They were not actually surprised on the positive the last couple of years, but this is a big positive jump. This is nearly a 40% jump in earnings. That's very, very strong. Look at that. They're going from $12 to about $15, $17, $5 jump. That's huge. 40% jump over there. And then in terms of revenue, they're jumping from what, 33 billion to what, 38 billion. So this is another 15% jump. That's another big jump as well. So that's very good. This is nearly a $5 billion jump. So almost close to about 20%. That's pretty good. Not exactly 20%, a little less than 15 to 20%, but this is the big story. This is a 50% jump in EPS. That's why the stock has gone up very well. Most people are expecting, there's not a lot of upside. There's about a 24% upside on the top, 28%. So this is right in the middle right now. My suspicion is it has got to come down a little bit. Earnings are in a couple of days. We should be able to get a little bit of a better picture, but the EPS growth rate is very strong. For an EPS growth rate of 40%, you're paying about, what was it, 60? What was it? What were we saying? 51 price to earnings. Still high. Not as low as this. Obviously, this was when they were growing at single digits, but they're growing much faster right now. They still will do well. I think they'll continue to do well. The stock on the long-term basis, let's go to the charts right now. Long-term basis, this is a stage 2 markup growing up and to the right. On the weekly chart, seems to be in a little bit of a range. It's consolidating. Earnings are in a couple of days, so I think that's probably the reason why. Am I seeing anything else? There's quite a bit of resistance here in the 692 zone, 700 zone. It's not even close to that right now, but no major pattern to think of. This was the up. This is no pattern at all. This is just, I thought would have been a good flag, but this is not even a flag. This is just consolidation. This portion is just consolidation. It could be a stage 3 consolidation before it goes down, or it could be a stage 1 consolidation before it goes up. Very hard to say right now. So on the daily chart, yeah, just consolidation. And it's already gotten to the 50-day moving average. I wouldn't be surprised if it touches the 100-day moving average, 544, which I don't think is going to do that anytime soon. But the earnings are out on 18th, which is tomorrow. Earnings are out tomorrow. Depending on the earnings, I think they continue to do okay. I don't think you're going to have a big challenge. The subscription count will definitely go up. I expect this to get to the top end of this zone, which is in the 640 range, 630 to 640 range. But the overhang in the market overall seems to be that they want to be able to have this a little bit more correctly valued. The RSI is pointing down. So look at this. This is the divergence. This is going up, and this is going, let's go back to where it was. Yeah, this is going down, not a good sign. This is going down, also not a good sign. RSI going down, MACD going down, RSI also pointing downwards. So this wants to move a little bit lower. Earnings will be good, I suspect, tomorrow. I'm hoping it'll be good. I don't have any information to tell you one way or the other, but my suspicion is overall with the market, this wants to take a little bit of a break. It may not get to 544, but definitely get to the 600 range, maybe a little bit more lower. There's good support for it over here in this zone, which is the 566 zone. Quite a bit of resistance for it here in the 636. So depending on how earnings, I wouldn't mind if it goes up a little bit, but then comes back down to test the 656, 660 range. Should actually get some point in time, even to the 562 range, but stock has just gone up way too much, man. This run up has been huge. Thank you for watching. Let me know what you think.